All right, Accounting 2 kiddos, it's been a while. Welcome to 5-1, where we will be talking about our merchandise inventory quantities again, looking at a little bit of determining the nature of merchandise inventory and also how do we account for the quantity of merchandise inventory. So, for most of our merchandising businesses, the cost of merchandise sold is our largest cost of doing business. So, making sure that we keep track of that is very important as a merchandising corporation. So, as a merchandising business, we try to make sure that we have good control measures in place to try to manage our inventory. Because in order for us to be a successful business, we have to maintain adequate amounts of merchandise, meaning we have enough merchandise inventory that customers are willing to buy. Businesses often fail if they keep too much inventory or too little inventory on hand. If you have too much, you have too much money wrapped up in inventory. And if you have too little and customers come and want something and you don't have it, it doesn't go well. We usually lose customers. So managers frequently analyze our sales and our inventory transactions to try to assist them in planning for any future inventory purchases that need to be made. So we can determine the inventory that is selling well as those items that are not. So that's very important for us to make sure we track customers' buying habits and also looking at seasonal trends. So are there certain items that customers buy more of at a certain time of year? And this allows us to make sure that we order the right kinds of merchandise at the right time. And that's what I'm talking about by making sure that we're maintaining quality control over our inventory. So, when it comes to our financial statements, an accurate ending merchandise inventory cost has to be determined in order for us to be able to report adequately what the financial progress and condition of our business is. And that's the accounting concept of full disclosure. If we didn't do a very good job of managing our merchandise ending inventory cost, then all of the following will be off. Our balance sheet is off because the cost gets reported on our asset section. Our income statement will be off because that cost we use is determined to find our cost of merchandise sold. And any error made in costing the ending inventory has a significant effect on our income statement, which, if we're talking about doing full disclosure, it means that we're being transparent in how our business is doing. And if we misreport a number, that's not full disclosure. So here below is an abbreviated income statement, and the left side shows the correct cost of ending inventory. Here you can see it's 700, and the right side shows the incorrect of 500. Now, the understatement of inventory causes our cost of merchandise sold to be overstated. So you can see if we only have $500 in ending inventory, our cost of merchandise is actually 3,300 instead of 3,100, which at the end of the day affects our gross profit as well as our net income, which are understated, meaning they're below what we actually have. So you can see how that's not beneficial. I know this only is $200, but imagine a corporation like Target that has millions of dollars in inventory wrapped up. And if those numbers are skewed, so is going to be your gross profit and your net income. Now, as I was just saying, if the ending inventory is understated, that means that the cost of merchandise sold is going to be overstated. And I can tell you that that is likely going to be a test question on the test, so make sure that you understand what happens if ending inventory is understated, meaning it's smaller than what it should be. The cost of merchandise sold will be overstated. And if ending inventory is overstated, then obviously the reverse would be true, and cost of merchandise sold would be understated. That also means that that would be additional income tax that would be paid on our overstated income, which would not be great. So neither of those situations follow the accounting concept of full disclosure, so we want to make sure that we are being as accurate as possible. So here's a statement of cash flows. It's the only statement that is not affected by any error in our costing inventory. You can see um, uh, what happens if we have the correct amounts versus the effect on ending inventory versus our misstated amounts. So you can see that nothing really changes other than our income statements, our balance sheet. Those all have amounts that would be misstated if we had an error in our costing inventory. Statement of cash flows is not affected by that error. Now, items in merchandise inventory we frequently refer to as goods, and typically a business counts as part of its inventory all of the goods that it legally owns. Now, we have worked with this one before, the price paid to our vendors. We have not talked about the cost of getting the goods to the place of business and ready for sale, which includes the cost of transportation. These goods don't just magically appear at your store. You have to pay to get them to you. And so that's what we're going to look at today. So businesses have to know both the cost of goods and the number of physical count of their inventory, or they can keep a continuous record. Both are good options, and typically most businesses are going to take a physical inventory at the end of the fiscal year anyways. Most businesses nowadays keep a continuous record because they use point of sale systems to help them do that. So when we have goods in transit, merchandising businesses purchase goods and services from their vendor. We know that. A vendor then sells merchandise to a merchandising business, and we often refer to that as a supplier. So the supplier ships the goods to the business. When goods are in transit at the time of a physical count of inventory, that business has to determine who holds the title of the goods. So if you are doing inventory at the time where the goods are being shipped, who holds essentially the rights to those goods? So when the title to goods is in transit passes from the supplier to the buyer, the goods become part of the buyer's inventory regardless of where they're physically located. So it doesn't matter where they're at in terms of transit. When the title to the goods passes from supplier to buyer, they become the buyer's possessions. Now, a supplier's terms of sale, and we've talked about terms of sale before. Normally what we have is we've talked about like our 210 and 30, or when stuff is due. But also on our terms of sale, they're going to specify something called FOB shipping point. FOB simply stands for free on board. And so FOB shipping point means that the buyer pays the transportation charges. So if we were the company buying the goods, we would end up paying the shipping charges. Under FOB shipping point terms, the title to those goods that are in transit passes to us, the buyer, as soon as the vendor delivers the goods to the shipping company. So as soon as, if we were buying from, let's say, Fleet Farm, and Fleet Farm is shipping our goods to us, as soon as Fleet Farm drops off the goods at the shipping business, they become the possession of us. So these goods in transit, not yet received by the buyer, are included as part of our buyer's inventory. So we would include those when we're doing our cost of merchandise sold assessment. If the terms of sale say FOB destination, which is free on board destination, then the vendor pays for the transportation charges, meaning the person that we're buying the merchandise from. And so then the title to the goods doesn't pass to the buyer until the buyer actually receives them. So those goods would be considered as part of the supplier's inventory and not as part of ours. So here it just kind of talks about, it's a little diagram that shows if we have FOB destination or FOB shipping point, and where the buyer pays shipping and when the title passes to the buyer. So remember, with FOB shipping point, as soon as the vendor drops those goods off at the shipping company, they become part of the buyer's inventory and the buyer pays the shipping. If it's FOB destination, notice that the blue line continues all the way until they're actually dropped off at the buyer. That's when the title passes, and then the vendor pays for the shipping in this situation. Now, there is always an opportunity that goods can be given to a business to sell, but which the title remains with the vendor, and that's called when you buy on consignment. The person or the business that receives the goods on consignment is called the consignee, or the consignee, excuse me. And the person or business that gives the goods on consignment is called the consigner. So this isn't as common, but they do want you to be aware of it. And so what happens is the consignee agrees to receive, care for, and attempt to sell the consigned goods. It's kind of like if you are like Kohl's Mentor or Plato's Closet in the mall. If the goods are sold, the consignee deducts a commission from the sale amount and then sends the remainder to the consigner. And in a consignment, the title of the goods do not pass to the consignee. So the goods on consignment are still part of the consigner's inventory. The consignee is just like the place where you could go to buy that. They're going to take a fee for performing that service for you, but that inventory is never actually part of theirs. And so what really is happening with that consignee, they are essentially have a liability to us, the consigner, because if anything happen to those goods before they're sold, they would be liable. And so we want to make sure that we're keeping a continuous record of merchandise inventory. We call that our perpetual. That's the day-to-day records about the quantity of merchandise on hand. And when we just keep track of when inventory goes sold, then we need to buy more. So for each inventory item, it shows us the number on hand, the number purchased, and then obviously the number that is sold. So these are the stock records. We've seen these before. The stock records, of course, are a form that's used to show the types of merchandise, quantity received and sold, and then the balance on hand. And then a stock ledger is going to be the file for the stock records of all the merchandise on hand. It's where we keep everything. So you can see this stock record is just for 6-inch drills. All of the drills would be kept in the stock ledger. Now, an inventory that is determined only periodically, where we count, weigh, or measure, is known as physical inventory. We've talked about perpetual and physical before, so those shouldn't be new terms to you. But for a business with large quantity of merchandise, it's a very expensive process for you to do a physical inventory. So it's usually only done once a fiscal period and once at the end of the year. So when you do a physical inventory, you keep an inventory record. You put the date, you put the drill accessories, and so you can see we have masonry bits. We had 120 of them. Our unit price is 125, so our total cost is 127.50. Our 6-inch drill extensions and our grout mixer, and then we have a total. And so we are going to be going over to our work together. We'll be doing some stock records as well as figuring out some inventory over there. So I'll meet you over there.